All right, let's start off. How much weight is actually on this jobs report when we know there's going to be other key inflation reports coming up later this week, another jobs report before the Fed meets again and makes this decision? How much weight are you putting on this?
Yeah, I think it is an important one, but there is going to be some weird dynamics in the data that we're getting this week. We know that maybe errors around this data are a bit bigger than usual just because of delayed collections, lack of collections. So that December employment report that we're going to get in a couple weeks before the January FOMC meeting, I do think that one's maybe a bit more important. It's a cleaner read on where we ended the year in terms of the labor market. But this number this morning is certainly important still.
When we're looking at the U.S. economy, if we're seeing unemployment tick up to just about 4.5%, I'm really kind of going back to Moody's points. We had Zandy kind of talking about this. Shouldn't we stop thinking that the economy is so strong if we're continuing to see unemployment at a level we haven't really seen since the pandemic? I think we forget October 2021 was in the middle of the pandemic. And also, it seems, and maybe it's just me, it seems like there's potential for inflation to reaccelerate. And so a lot of notes are coming out in recent days kind of pointing out that possibility.
Yeah, no, I do think this is a really fragile, precarious position, especially for the labor market, because, yeah, 4.5% unemployment, it's still a relatively low level, although interestingly, the Fed doesn't necessarily describe it that way anymore. But it's really that consistent increase and the very low hiring that we've seen for about 2.5 years now. I would want to see that dynamic changing to feel better about maybe the next step in this labor market is layoffs. We don't see that yet, but I would want to see labor demand start to improve to not think that's a risk.
All right. Let's get to your report and your data. You see 50 basis points of cuts coming up next year, and you say the market's underpricing the risk there. What's the risk? Are you saying the economy is so weak that it mandates 50 basis points of cuts?
Yeah, the risk would really be that we see more weakening in the labor market. So we do think that by that December employment report, which we'll get before the January meeting, we could see the unemployment rate at something like 4.7%, even a bit higher than 4.5%. I think that's enough reason for the Fed to be cutting again in January. I am a bit, by extension of seeing that labor market weakness, I am a bit less concerned on the inflationary pressures also. And I would worry that if we start to see any signs of layoffs picking up, this could be a much worse situation for the labor market that the Fed is cutting more in.
All right. We had Stephen Myron on our show, or air yesterday, I should say, not the show, but on air. And something he pointed to is that he's not that worried about inflation reaccelerating because he feels like shelter prices are moving to the downside. He's looking at market rent data. Are you seeing the same picture that shelter is going to ease and that's going to just kind of stabilize inflation?
Yeah, I actually think he's incredibly right on this point. All the leading indicators that we look at to determine where we think shelter inflation is going, which is a really large share of CPI and PCE inflation, they've all been softer for about a year now. That's home prices, market rent data. So we would expect that this is a very delayed calculation to catch up to market trends, but we would expect that shelter inflation could be softer than usual for all of next year.
Okay, but even he pointed out to the potential, at least, for goods inflation. So how do we balance that out? The fact that, yes, housing is obviously a huge cost for just about everybody, because I think all of us spend a large portion of our income on our housing. But if goods are going up across the board and people are being laid off, doesn't that set us up for a pretty significant, or at least the potential of a significant slowdown?
Yeah. So we could see that stronger goods inflation. I do think that can be offset with softer shelter inflation. But the third important component of inflation is all the other services. And those do tend to be very dependent on wage trends, which, of course, would be dependent on, is the labor market weakening more? Is labor demand loosening? And we did have the employment cost index data out last week for Q3. We did see the softest increase in employment costs in a while. So it does seem like wage growth is slowing. And yeah, you're less concerned about that other component of inflation then. All of that does kind of point to inflation is slowing in a softer demand environment.
All right. We talk a lot about the AI trade here on CNBC and the build out and some questions about it. Some of the investor questions about the viability of all this. How do you see that playing out when it comes to GDP? Do you see the continued build out of AI? This seems to be a driving force for GDP going into next year. Of course, there's a lot of commitments out there, but it can't just be the big companies doing it. We have to see other companies doing it that can maintain the kind of growth that we've seen.
Right. As macroeconomists, it's very hard to take these announced investment plans and put that into a forecast because, what we want to know is what happens to aggregate growth. And certainly that could be a strong story. I imagine we'll still see that investment in, computer equipment, things like that in GDP. But you do have to weigh that, maybe some of this investment is just diverted from other sectors, would have happened anyway somewhere else. And the aggregate impact is not so clear. And I would, caution also that, some of the strength that we had in that equipment investment earlier this year, it did seem to correspond with maybe some front loading of computer imports and things like that. So yeah, I would worry that on aggregate, it's not so clear that this is all a new strength for business investment.